Recently, three of the greatest investors of all time have commented on their thoughts on the stock market. What does it mean potentially for you and your investment journey? I'm going to share their thoughts in this video. If you enjoy educational investment videos, you're watching Unrivaled Investing. I appreciate that thumbs up, that subscribe button. So the first investor that we're talking about is Stanley Druckenmiller, a billionaire in his own right, talking with Paul Tudor Jones at a Robinhood conference. And for context, Stanley Druckenmiller generated a 30% annualized return for 30 years without a single down year, arguably the best investment track record out there. He has a few core beliefs, one of which is that interest rates are normalizing, not necessarily that they're high, but that they're normalizing, that if you have inflation, persistent inflation at, let's say, 2 to 3%, plus reckless fiscal spending, maybe a 5% plus long-dated bond yield is actually very reasonable. And he's saying, look, it's important to have a multi-decade context on where things can be, not only with interest rates, but also with valuations, thinking that the S&P 500 is potentially overvalued, especially when you consider where cash is. I personally keep my cash at Interactive Brokers. Cash is currently yielding over 4.8%. See the link below. He's making the point that if you are no longer in a zero interest rate policy, zero interest rate environment, you need to adjust accordingly. And a lot of people will say, well, wait a second, look at the US, valuations since 2000. Well, since 2000, you had, for the most part, a large period of zero interest rate policy. So valuations should be higher. But if you take a longer time frame, looking out at real interest rates, he's saying it might be more appropriate to think about a long-term multiple closer to 15 times. And that makes sense. Once again, cash at around 4 or 5% in earnings yield that you might say, hey, I want to get rewarded for maybe 5, 6%, maybe 6, 7%, in which case you're talking about maybe around 15 times earnings multiple. Now, this could be even worse if he's right, which he's also starting to see some early signs, early recessionary signs. So not only could you see a potential valuation headwind, you could also see a fundamental headwind. So you get hit on valuation, that brings you down 20, 25%. Then you get the fundamental impact as well that could hurt the S&P 500, causing you to possibly go through the lows from last year in 2022. But he does have an open mind. This is Stanley Druckenmiller sort of recapping his core thoughts. He does have an open mind saying, look, next year's an election year, and based on which candidate wins the presidency and their policies, it could have a wide range of policies, wide range of possibilities. You look at Donald Trump, he's known as being a big spender, has had multiple bankruptcies. If he's elected again, what you could see is a possibility of lots of reckless spending in the US. You could easily see inflation, start up again, really pick up. And you could also see the possibility that equities get a bit higher in that type of environment because maybe he puts someone in the Federal Reserve that's sort of a puppet and that doesn't, tighten monetary policy. And so you really get, the animal spirits going with equities. The other possibility is that who knows how this plays out. It's important to keep an open mind. And this is something I appreciate about Stanley Druckenmiller is, the humility of him saying, look, there's a lot of possibilities. I don't know for sure which one it plays out. But, different candidates might have a strong deflationary impulse saying, look, there's, 50% of government spending might be wasteful. There's a lot of cuts that need to be, considered. And if that happens, you could certainly see a pressure and impact on GDP and the economy. So it is important to keep an open mind in terms of seeing how the elections play out. There was also two other great investors that were recently quoted from an article with Andy Soar, where he was talking about the history of the investors that have come from Fidelity and Mutual series. With Fidelity, you have Peter Lynch, who wrote several famous Wall Street books, one of which is One Up on Wall Street. He generated a 29% annualized return from 1977 through 1990 through the Magellan Fund. And he thinks, look, over the last 2 years, you've effectively been in a bear market. So now might be the time to be finding opportunities. He talks about small caps being compelling. And he has an argument here. You look at small caps where they were at their lows last year, and you're right around there. You have seen no gains from the lows last year over the last 2 years. Small caps, this is via the Russell 2000. This is down a total of 25% total return down. So investors in small caps, medium caps, they have really lost it. It's only a few handful of companies that have done well. And Peter Lynch loves it. He loves seeing a bear market. He loves seeing stocks go down. And I don't blame them. That's the right mentality, which is that if you have a company that's generating increasing profits, increasing free cash flow, and the stock price goes down, you love it. Generally, it means you can do more buybacks. You can do more cool stuff. If the share price goes lower, you can retire more shares. But that, once again, requires that the company's delivering and it has the fundamentals. So, or you as an investor can buy more. So I appreciate the sentiment of, hey, he loves seeing that stock prices go down. I love the Peter Lynch mentality. It was also quote from Seth Klarman, who runs the $20 billion plus Baupost group, where he is a little bit more conservative. He was a student from Michael Price, and he talks about how the market is scary and vulnerable. The geopolitical strains seem heightened rather clearly. I think in some ways the magnitude of the disaster of the Fed holding rates at zero for a decade is now much more clear. This is more of a conservative, concerned perspective, not really calling out specifically on what he thinks is going to happen. What are my personal thoughts? First of all, in full disclosure, this is not financial advice. Second, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for premium annual subscribers. So, you might say these are all different investors, and how is it possible that you get something that works out, that could even satisfy all three? And so I think there is a possible way to say, hey, you could get something that actually makes sense, considering all three. And when you start thinking about it, okay, so you have Stanley Druckenmiller who's saying fiscal policies are completely out of whack. The U.S. government's going to need to cut back on their spending. You're going to see that as a headwind in the future, possible recession. He's also calling out. You see Seth Klarman talking about concerns of a recession or talking about a very scary macroeconomic outlook. And then you see Peter Lynch, who's sort of the ever, forget the macro. Don't worry about the macro. Just focus on finding great companies. And I love that mindset. And that's the reason why I keep a copy of his book over my shoulder. It's the right mindset of don't get overly distracted by the macro. Just focus one company at a time. And I think there's a way to, try to get it all. And so let's look at an example of a company that Seth Klarman was buying. And, I've called this out before where he was buying Dollar General stock. So let's say you're right. There's a recession, Dollar General historically has seen more customers, more demand when there's a recession. You sort of have this downtrade demand pickup because people say, hey, I can no longer afford, to go to these other grocery stores. Now I'm going to the lower cost option that I might have. So, it's not surprising to see Dollar General being purchased by Seth Klarman. It's also a situation where when I check in with AI Ticker Chat, first month is free, covers all U.S. stocks above $300 million market cap. It checks in terms of what do you predict, a hypothetical framework for how does Dollar General perform in the future. It's aligned with, what I've called out myself in a prior video. See that yourself, if you're interested, saying, look, there's potentially 100, 200% upside if they execute where, margins revert higher or back to where they historically were and they get a little bit of growth, and assuming the multiple stays roughly around where, it historically was, around 18, 20 times multiple, you could see a lot of upside and, potentially a lot of free cash flow go to shareholders. So, I look in and I go, okay, I agree with that sentiment. Look for the types of turnarounds, the type of situation where, they missed for several quarters, the CEO gets booted and the old one comes back. That's what's happening with Dollar General. So, even Peter Lynch, he had a play for finding these types of turnarounds. But I think it is important to recognize that, this Dollar General is sort of a one-off of, what can all make work, what could work potentially for all three. But I think it is important to reflect that if there is a recession, then it generally is going to be tougher to generate attractive and compelling returns. And in which case, holding that cash balance, getting that 4 or 5%, that's probably a better position to be in. That said, I do believe that as this plays out, you could see tremendous bargains. You can see things where you're going to say, hey, there's a lot of upside. And I am seeing some of it. I call it out to my subscribers at Unrivaled Investing, especially with some of the small and mid-cap stocks. I've been buying some of those for myself where I'm like, oh, I can pencil out 300 to 400, 500% upside for some of these smaller situations because I just think they are being mispriced. So I agree with Peter Lynch in that dynamic. There are some small and mid caps where you can say, okay, this is a company growing at 30%, trading at 12 times earnings. That's interesting. Whereas I'm also very mindful that that Stanley Druckenmiller, might be right. We might be in for a long period where the stock market goes nowhere, in which case you really want to have these companies that can return that cash flow to you via buybacks, and that it might be a bumpy ride. So be prepared and have some liquidity to act should things turn worse in the future. That's my own personal perspective, and I do have a sizable cash position, and I would personally be prepared to potentially even margin my account, a small degree, not a huge amount, if it was just overwhelming, in terms of the opportunities. I don't think we're there yet personally right now as I'm looking at the landscape. So if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.